Hello, everyone, and welcome back to another episode of Creating Wealth. Marjorie Roman here, and we have our amazing training and mentor, Robert Allen. How are you doing, Robert?
I am doing awesome. Every day is a great day, especially when you own lots of real estate and you're creating wealth and you're changing your life and you're reaching your dreams. And what could be better than that?
That's right. And thank you so much for coming over to teach us more about it. So today we're going to talk about seller financing. What is seller financing?
Well, when you buy a property, you have to put a down payment. That's not seller financing, but you have to get a mortgage. And that's usually what they call seller finance or financing of some sort. A mortgage means usually it's 80, 90% of all the money that you borrow for that house comes from somebody. And traditionally, it comes from a bank, a mortgage company, a financial institution, savings and loan, people who are in the business of lending money out to people who have homes. And they secure that home with a first mortgage. But most people don't understand that anybody can lend you the money. It doesn't have to be a bank. It could be somebody who has 80 or 90% of the value of the property that you're buying. It could be a friend of yours. It could be anybody. What they do is they would lend the money at the closing. They would lend whatever it would take to create the mortgage, and they would sign two documents. One's a mortgage. That's a collateral agreement. That means this mortgage is collateralized by the property. If you don't pay the note, which is the second document, these two documents, a mortgage document and a note, the mortgage is attached to the property. If you don't pay the note, then they take the collateral. They take the property to pay back the fact that you didn't make your monthly payments. Now, there are 2.5 million properties in America in foreclosure right now.
Oh, wow.
Now, as we're coming out of COVID, why are they in foreclosure? Because there was forbearance on these mortgages. The government basically said, you can't foreclose. There has been a pandemic. You cannot take these properties from these people. So by forbearing, they literally pushed off the deadline. They pushed off the date when the bank was going to foreclose on a property. So we're going a little bit side difference from where you were sending me on the question. But what I'm trying to say is this mortgage that they had was financed. And since they couldn't make their monthly payments, the collateral owner, the mortgage holder, is going to take it back. Now, with these new foreclosures coming on the market, will they get snapped up because the market's pretty hot? Maybe. Maybe they'll be able to avoid their foreclosures because the prices have gone up so much that they turn around and sell it and get their money, pay their loan to the bank, etc. The financing part is the two fundamental things you have to finance is the down payment. And what if you don't have the down payment? There's a 50-0 down techniques on where to get that down payment. But the rest of it, the biggest chunk is somebody is going to lend you a lot of money secured by the house. So most of the time it's a bank or financial lending institution. But as I mentioned in a previous podcast, 45% of all the houses do not have a mortgage against them right now in America. 45%. That means that the owner owns the entire property free and clear, is the way they say it. The owner, when they sell it, they're probably going to hope that it's all cash. If it's all cash, then that means somebody had to lend the mortgage money to the new buyer and the seller walks away with all cash. What if the seller doesn't want all that cash? What if they don't want to have an immediate big cash infusion that was going to be taxed? What if they took a smaller down payment, which means they received less of their money, therefore there's less taxes, and received their money with an interest rate attached over a period of 5, 10, 15, 20, 25, 30 years? Maybe a seller could be educated that there is another way to do it besides the traditional realtor way, which is, Mr. Seller, what are you going to do with the money? You're going to pay a lot of that money in taxes. Why don't you lower your tax bill? Why don't you increase the rate of return you're going to for your money? If you put it at the bank, it's 0.5%. If you put it at a government bond, it's 2-3%. If you put it in a corporate bond, it's 4 or 5%. Why don't I pay you 5, 6%? I'll be the person that will make you the monthly payments. You'll lend the money to me, secured by your property with a first mortgage. Therefore, if I'm not making the monthly payments, you get to take it back. But obviously, I want to make those monthly payments. Now, these kinds of transactions usually are done between a seller who doesn't need the financing, doesn't need the money, or a seller who has a situation that's needs to sell quickly and that doesn't want to wait for, how long does it take to get a property refinanced? It's going to take at least 30 days, maybe 6 weeks, maybe 2 months. And what if they needed the money immediately? They needed to sell immediately. Like literally tomorrow, if you are borrowing from the seller as owner financing, literally tomorrow, you could give that seller a minimal down payment. You could say to the seller, I'll make you monthly payments. You'll be the mortgagor, the person who holds the mortgage. I'll make you the payments every single month. If I miss 90 days, in most states, it's about a 90-day foreclosure. If you miss your payments for 90 days, then they can launch the foreclosure proceedings, which takes about 90 days. So actually, you can start foreclosure even before that. But what I'm saying is, Mr. Seller, I'm going to give you a better interest rate, an immediate sale, lower taxes, and we can do this. We can do this right now. You don't have to. Yeah, we can get it started immediately. Some sellers will like that. Some sellers won't. So if they don't like it, what are they going to do? Well, they'll probably put it on the market and wait for somebody to qualify for it and get all their cash. But what if they got a lot of cash? What if you could say to that seller, what are you going to do with the money? You've already bought another home. Mm-hmm. You've already got a mortgage on something else. You're going to have a big chunk of cash just sitting there. I'll be your bird dog. We'll use your cash, my expertise, my knowledge, my time. I'll go look and find deals for you that you could not get in any other way. You don't want to offer that as an option until you know that they won't do seller financing. But if they won't do seller financing, that means they're going to get a lot of cash. Therefore, since they had a lot of cash, let's go buy real estate with it. Let's invest it for you. And therefore, anytime somebody sells, they not only can be a seller, but they can also be the new buyer with you for something else. Now, they're going to say something like this to you. I don't trust you. I don't know who you are. You're just going to give me a minimal down payment, and you're going to make monthly payments to me. I don't know whether you can qualify. I don't know anything about that.
So how do you present that offer then?
Here's how you do it. You say, Mr. Seller, I realize that this might be a little out of the ordinary, but I tell you what, I want you to feel safe. So I'm going to get a life insurance policy on me. I'm going to pay not only will I make the mortgage payment to you, but I'll make the payment for my life insurance policy. If for whatever reason I should happen to accidentally die, the house, your mortgage, the mortgage that you've given me will be immediately paid off. You get it all. You get all the money so you don't have to get monthly payments. Or I do have another property. It's a single family. It's a vacant lot. I'm not going to build on now, but it's paid for. I'll tell you what. I'll put a mortgage on both of those properties, not only on your property, but on my property. So if I don't make my monthly payments, guess what you get for collateral? You get both properties. That's called a blanket mortgage. And most realtors have never heard of that before, because a mortgage is a collateral agreement and a note. And on the collateral agreement, that means what will we use as security? Not just the house you're buying, but some other property you might own. Maybe you own a mobile home, or maybe you own a motor home, or maybe you have, maybe you invested in some gold, and you've been stocking $5,000, $10,000 worth of gold, and you don't want to sell it, but you could use it as collateral to make the seller feel comfortable. Now, could you say, Mr. Seller, obviously we need to have some history. I'll make you monthly payments if I'm on time. every month, as I said I will, within a 5-day grace period. If you receive that payment every month, as I said, within a year, you'll have an experience with me. You'll know who I am, whether I'm legitimate or not. At the end of a year, I want you to remove the mortgage from my lot, from my gold, from my motorhome, from my motorcycle, from what other asset I own. Remove it, and we can set it up in an escrow, meaning it's done at one time when I buy it. At the title company, we literally set it up that if the payments arrive at the title company and then transferred to the owner the way you said they would, if they're on time every single month for 12 months, then a new mortgage, a new collateral agreement is automatically done. And therefore, the collateral, the mortgage will be removed from your free and clear lot, and the seller now has less collateral. But he has history with you.
Right, and
so
he's more confident of being
totally
in business with you.
So in other words, nothing down means how do you show the seller that there are benefits for doing it a creative, unorthodox way versus a traditional all cash way. And sometimes, obviously not every seller is creative like that. That's why you're looking first for the highly motivated seller. Then all these kinds of things are much easier to do.
So how do you find those sellers then? What are some of the tricks that you used?
I'm looking for the word "don't want her" conditions. So every single letter represents a condition. So D, divorce; O, out of state owner; N for negative cash flow; T for transfer; W for and I go down the whole list. Just use your common sense. Why does somebody need to sell? Is it death? Is it sickness? Is it another investment they want to put their money into? Therefore, they're willing to lower the price on their home to get quick cash so they can go put it into crypto or something, and some other thing they really believe in. So there are reasons why people become or forced to become flexible, creative. So you deal with those people. You search for those people, and they're more difficult to find, especially when the market is really hot. When it's hot, everybody just goes, well, I'll just get my price and then go take my money where I want. As the market gets softer, and that's going to happen here in the next 5 years, the market will get softer and softer and softer. As it gets softer, sellers become more and more flexible because there's no other option. Right. And therefore, if they need to sell and it takes 90 days to sell and they need to sell next week, creative financing. Absolutely. Seller financing.
They can sell it this quick.
Exactly. That's what it's all about.
That's amazing. So what are some of the other benefits that you have seen of using creative financing or seller financing?
The advantage is for you as a buyer, you don't have to go to a very difficult bank. Getting a loan is hard. And since 2008, when it was easy to get it, almost anybody could qualify. Now almost nobody can qualify. And as the interest rates go up, it gets more and more difficult. So I'm looking for situations where I don't have to go to a bank. I call it the creative non-use of cash. I don't want to go to a bank. And going to a bank is almost the worst thing I can do because the banker is going to have these rules, and the higher the mortgage rates go, the tougher the rules get. So don't use a bank. Don't. Now,
there's way better options.
Should you buy a property if that's the only option to you? Of course. Yeah. Get in however you need to get in. But if you can't qualify for a loan, then the next option is who could. So can I get that person to qualify for a loan for me? Or I can partner with that person. They have the strong finances. I have weak finances. We get together. We split the profit 50-50. Yeah. So let's put it this way. There is always a way. There is always a person who is open to something like this. There is always a way to find a combination of techniques, creative financing, to satisfy them in a way they feel happy. They go, yeah, I like that option. I get a higher interest rate. I get a faster close. I get extra collateral. I get a high, there are reasons why people do this. It's not just what most people think. It's like I'm always taking advantage of the poor people. Oh, no. The poor people behind their mortgages, creative financing is solving a seller's problem without the use of your cash.
That's amazing. And I feel like it's a win-win situation because like when you're using seller financing, not only you as the buyer are getting the advantage of like not using your cash to get into the game of the real estate, but also the person that is selling the property, they also get quite a bit of advantages. What are some of the other advantages that you would mention for the seller from using seller financing?
Well, I'm going to take you in a different direction. I'm going to take you in the what are the disadvantages?
Oh,
Because yes,
are there
yeah.
any disadvantages?
Yes, there are.
Let's
Yes,
hear
there,
it.
yes, there are. So it'd be nice for you to know that because they may throw this back at you. They might say, yeah, but the first disadvantage would be the note that you create, the mortgage you create literally is a long-term contract. And what if 5 years from now you really want your cash and the mortgage has gone down 25% and 75% is left and you still have another 20 years to go? In order for them to sell that note, they would have to discount it, meaning they'd have to sell it. Suppose it's a $200,000 loan and it's been paid down to $150,000 and they wanted their $150,000. Well, they're not going to get $150,000 in cash. You know, a person is not going to say, take their mortgage from them and say, okay, I'll give you $150,000. You give me your mortgage at 6% interest. No, they're going to want a discount. They're going to want a 10%, 20% discount, you know? So the disadvantage is for the seller that the note, if they want to be refinanced, if they want to be, paid off from the buyer of a note, they'd have to discount it. However, if somebody is coming into the home to buy it, and therefore they're going to get a brand new mortgage to refinance it, then they would refinance the full amount to the previous mortgage holder. This is really sexy because sometimes when you find out there is a previous mortgage holder and you realize that if you buy that property and it gets refinanced, they're going to get a lot of cash. What if you went to them before you bought it and you bought an option to buy it at a discount?
Oh.
So
how
you
does
research
that work?
people, watch this. You research people who have a seller financed mortgage. When I see that, I go, oh, baby, this is nothing down. This is fantastic. Because they're going to take a discount. And therefore, if you go to them and you say, I might be coming into some cash. Your note's $150,000. You're receiving this interest payment for the next, 25 years. Would it be advantageous to you to receive all that money now in cash? If you would, I'm going to offer you a 20% discount. That means it's a $150, but I'll give you, what's that, $120? I'll give you $120. But I'm not sure if the money's going to come through, but if it is, here's $500 as an option. If the money comes through, what I'm thinking it will, then this option is good for 90 days. And if I actually pay you the $120 in cash in 90 days from now, then the $500 is free. You keep that too. Mm-hmm. So it'll be 120 plus the 500, right? But if I don't happen to come into the money within the next 90 days, then you keep the 500. Yeah, you didn't get your money, but it didn't come through for me. Okay. Now, this doesn't work for every mortgage holder, but 1 in 10 is going to go, I can get all my cash now? What if it was 15% discount, not 20%? Yeah, I might consider that. Oh, okay. Now, when you make an offer to buy the property and you negotiate to buy it, the underlying mortgage holder is sitting there at a discount to you because when you refinance the property, all that cash is going to come in to pay off that mortgage, that $150, but the seller's already agreed to only take $120 of it. Therefore, where does that extra $30,000 go? It goes to you as the buyer. And what do you use that $30,000 for? As the down payment to buy it in the first place. In other words, their down payment is in the discount that came from the mortgage holder. That's a nothing down technique. Oh, I can teach you 50 techniques like that. And no, they don't always work all the time. You might try it and the guy says, no, I want my cash. Another person might say, no, I won't take 20%, I'll take 15. Another person say, I'll take 10. In other words, but extra money goes into your pocket. And you can now focus it back as the down payment, focus it to fix up costs, whatever you want, it goes into your pocket, see? And most realtors have never even considered anything like that. That's why I'm the king of creative real estate.
That's right. And we are super excited to actually have all of that expertise and all your teachings on that. Because most people, they don't think that they can get into the game of real estate with nothing down. They are like, no, this is way too hard. I cannot do it. But just having you in each of our podcasts and talking to us about all of these many amazing techniques, if one didn't work, don't worry. You've got 49 other ones.
Exactly.
You can still do it.
It's a mindset. A mindset is, I'm not going to buy this thing with my money. Rich people do this all the time. They say, I'm going to raise the money from somebody else. I got one of my students who's a multi-millionaire. He refuses to put a penny of his own money in his commercial real estate deals. He brings all the money from all kinds of other sources, brings the banks in, everybody else. Every time it's nothing down to him. And that's how he parlayed a little bit into a massive amount.
That's amazing. Well, thank you so much again, Robert, and super excited to have you as our mentor, our Nothing Down mentor. Thank you so much to our audience. And if you really want to get into the game of real estate, you have your mentor now, Robert G. Allen. Thank you so much and see you on the next episode. Bye-bye.